It's like driving to work. You leave the house on schedule, you follow the same road, and you get to work on schedule. And if anything creeps up in your path, you'll still get to work on schedule, right? You'll figure it out. That's what trading on schedule is.
So we're going to do sitting on with Jean François Boucher. Jean François has been on a podcast here on the show a few times. We have a few videos together. A scalper, one of the only guys who scout the way he does, especially putting this out to people. So I know you guys like the old interviews we had, so we do another one today here. I'm going to go do some live trading together. So Jean François, let's dive right in. Tell me what you got to show us today.
Sure. So I was trading earlier with someone else. So there's trades that you can see here that have already closed, but I'll review the process very quickly so that everybody can get a grasp of the environment that I deal with every day. Okay. So I come to work, I come to my computer after the stock market has opened every morning. So I wait about 30 minutes. And so the stock market opens, volatility comes, settles down somewhat, and then I show up. And then when I come to the computer, the first thing I want to look at is the news calendar. I need to review what kind of news will be impacting my trading, if any. And today I came in realizing that there would be US PMIs and new home sales. And so sure enough, I took a pause about 10 minutes before the news came out. The news came out. We started trading, myself and my student, about 10 minutes after, 15 minutes after the news, realizing that it was not going to go to the moon, right? Because we had already taken a look at the daily candle. And our daily candle today had reached 73 pips on an average of 63. And so we already understood we had done more than the average. And that happened all at once as a result of the news. And so from that moment, I started looking intraday. And so on the hourly scale, I want to see the extremes and what levels would I be dealing with? Where do I expect some kind of resistance, some kind of support, some kind of price action to be presented? And so I don't know the future, but I can look at the past and see where things took place before. And I can anticipate similar price action or similar reaction to price action in the future. It may or may not happen, but it's an expectation. Right. So on this intraday, this is an hourly scale. On the intraday scale, I'm just looking at levels that were useful in the past. So this could be days ago. This could be hours ago. This is on the way down. And I'm thinking on the way up, we'll be revisiting some of these areas. Right. So we've already revisited two of them. There's a third one marked up there, and just in case. Right. So this is from the top down. I've already assumed that daily candle was bigger than average. On an hourly scale, we're making higher highs and higher lows. On a 5-minute scale, we can start to see, on the 5-minute scale, we can start to see where we as traders may want to take action, right? So if I'm looking intraday, so this is on the 5-minute, I'm just looking in the past 30 minutes, 40 minutes, maybe an hour. I'm not looking very, very far in the past, right? I'm just looking where we came from today. And in this environment, I can have a call to action, right? So if we get back to this line here, I can choose if I want to buy or sell, right? I have something to expect if we get to this level, right? I have something to expect if we get to this level. And as you can see, this is creating a ladder, right? So I'm building a ladder. I'm creating an environment where price is now trapped and it has to go through these lines. And as it goes through the lines, I get to ask myself, do I want to short here or do I want to go long from here? And so realizing that I have a top-down analysis, I have a top-down bias, I have to follow along with that bias. And then this just adds conviction to what I'm trying to do, right? So this call to action is either going to reinforce my bias or tell me to get out, right? It's going to tell me that something is wrong. And so on average, these lines happen to be about 9 pips apart, right? So if we measure this, this is about 67. The average is about 9 pips. All right, so if we do this over and over and over and over, this is 5. You'll find the average is about 9 to 10 pips. There's 10. There's 12. There's 12. And so what we've come to realize is this average, more or less, is the sandbox we want to be playing in every day. And it doesn't change all that much. And so if you go to the left and you measure these swings day in, day out, and you average them to each other, you'll figure out very quickly that you end up with this unit of measure, right? This box. And the box itself, for the euro, is 9 pips tall. And it lasts about 1 hour long, right? So now we have this frame of reference, right, which represents an average move. We know it's 9 pips, and the average move is an hour long. And you can see here, if I put the box on that swing high, we moved the 9 pips, but we did it in 9 minutes, not an hour, right? It did not take the whole hour to go across the box. It only took a few minutes to go across the box. And so that screams at us that there's another box coming. And sure enough, the market gave us one more box, right? So it moved 2 standard deviations. And then from here, it seems to have found support. And we're bouncing off of support instead of breaking through it, right? So understanding where we are now, looking to my left, I see resistance right here. Right? Let me turn off these blue lines so that we can have a better idea. All right, so as we speak, we bounced into resistance, and now we're bouncing off of resistance back towards the low. And as we speak, we are in the middle of the box, and so what could happen next is undetermined, right? It could bounce up and go through the top, or it could bounce and go through the bottom. The center of the box is 50-50, whereas the edges of the box have a much, much higher probability, right? Because it's a measured move. We measured this to be an area where we expect to see a bounce.
Does that mean you would be trading within the box, or would you still place trades there?
Yeah, so I do want to trade within the box. That's where I make my money. And then the perimeter of the box allows me to manage the risk, to gauge how much money I've already spent and how much I have left to spend, right? So I'm using the perimeter of the box as a security blanket. It tells me if it's safe to keep going or if it's time to back off, right? So if I don't have the box, I'm just looking at price, and price is reflecting the truth, but it's not telling me what is the next move. If I put the box here, I already expect the next move to be a bounce back down because of this amount of movement we've already done. This right here is an average move. And so if I remove the box, do I know that this is an average move? Unless you're a carpenter and you know what an inch looks like without a measuring tape. I myself, I can see the 9 pips without the box because I've been doing this now for years, right? But for most people, you need the security blanket. You need the measuring cup to measure the recipe, right? So as we see, we've moved 1 standard deviation. We're bouncing off the box. And from here, I can see resistance on my left, right here. If we go back up, so a green candle will allow me to sell, right? I don't want to sell when it's red because that would mean I'm chasing it down. I want to sell it when it's expensive. So a green candle, right? I know I want to be a seller, but I want to sell expensive. And so I have to sit here and I have to be a little bit patient and wait to see if I get a green candle, if I get an opportunity to sell it expensive, right? If I turn on those blue lines, you'll see how I was trading earlier.
Hold on a second before you get there, because a lot of people would be scared to go short on a green candle. They would be scared to get in when price goes against them, by the way.
Yeah, so this is it, right? Imagine yourself chasing the market at the very, very top right here when it's green, green, green. What makes you think that there's more green coming? We don't know if there's more green coming. And so most people will realize, oh, it's a breakout, it's a trend, it's the beginning of a new trend. According to industry standards, we're breaking out, right? So a lot of people will jump into this because of fear of missing out, right? It's green, 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 it's a breakout, and it's heading in the right direction. All the check marks have checked, except what comes next is the opposite. And so what we need to figure out is measure this kind of stuff and understand what's the likelihood of that going to the moon, right? So if I measure from the low and I start adding more boxes, already I know that the moon is unachievable. We've moved 3 standard deviations already. Right? So instead of buying at the 3rd standard deviation, I've been training myself to sell. Right? Imagine this being outside of the Bollinger Band. Right? It's now way outside the Bollinger Band. Right? So this is kind of the box. The box gives you a frame of reference and it puts it in perspective. It's normal or it's outside of normal. And if it's a normal environment, I make 3 pips, 3 pips, 3 pips. If it's outside of normal, I manage the environment. I manage what I'm up against, right? So if I take a sell right there, I'm selling inside the box right here. I'm selling on that green candle. My target is right there, 3 pips in front of me. My target is right there. And my stop loss is 36 pips away, right there. That happens to be 4 boxes away from the entry. Right, my entry is a little bit lower, so there's the space there. Right, so I'm giving myself space to get the job done, and the job that I'm seeking to do is to average with this first trade if I must. Right, so if this does not make me 3 pips, so if it does not go my way, I need to somehow average with it more money, engineer the exit that I'm looking for, right? So, for example, the market goes up to here and starts to go sideways up here. I could take another sell there, averaged with the original sell. The average price would be somewhere in the middle. And I would only be requiring a little bit of a pullback to get out at break even. Right? So even when things go backwards, it's not the end all be all. There's a way out, provided you have a little bit of money. Right? The problem we run into is we over trade and we don't have backup for the backup. We don't have money to save ourselves with. We put it all on the line. Right? So a lot of guys, they'll put 1% per trade, but then they have 10 trades. So that's 10% of their account. And now they're freaking out because drawdown is chewing into the other 90% that they have left over. What I come to realize is I need that drawdown, right? I need to float some money in order to make some money. I have to have open trades to close trades, right? So if it pushes back up, there's that green candle again, right? I'm making lower highs, I'm making lower lows on the green candle. It's giving it to me on sale, right? I just sold it when it was more expensive than 1 minute ago. Right? The reason why I want to sell when it's expensive is if I'm right, and this is resistance, this is an area of resistance, the bounce will come at me in a hurry. It will come very, very quickly, right? And so by selling when it's expensive, I almost guarantee my exit if I'm right. If I'm wrong, I just go into drawdown. And that requires me fixing drawdown. It's not an automatic loss. And this is where the people have an issue with this strategy, right? Because the industry has them trained to book a small loss. Book a loss, book a loss, book a loss, and then when you are winning, you pay back your losses. And so you remain breaking even. It's hard to get ahead if all you do is lose, lose, lose. Right? So what I've come to realize is I need to float some drawdown. I need to have a float in my cash register so I can make change all day, so I can do business. Right? So this is it. I'm opening trades, 4 trades per box, and the size that I'm using, 4 trades per box, is approximately 1% of my account. Right? So I take that 1% that the swing trader is taking, but I'm breaking it up into 4 pieces. And I spread these 4 pieces according to what I see fit, right? According to what I see in front of me. And so I'm spreading my risk instead of putting it all at once, hoping that I'm absolutely right. And the average of me spreading that risk is what I control, right? That dotted line here is the average of the 2 trades that I've already taken. If the market pushes up into this upper box, it entitles me to 4 more trades. The next 1%, and then the next, and then finally the last. Right? I'm only allowed to have 4% of my account at risk. So that's 4 boxes worth of trades, all in the same direction, all looking for that same move. Right? So I'm spreading my risk, much like butter on toast, right? And the size is the thickness of my butter, right? And I'm using the same piece of toast every day, right? So I'm always spreading the same amount of risk, hoping to yield a potential average yield every day, PAY, potential average yield. Right? So I recycle the same number of trades day in, day out on average. Right? So that would be about 30 to 40 trades per day. And that's within that 2-hour window that I create for myself. Right? The rest of my time I dedicate it to teaching this stuff. But my live trading is done at the same time of day, every day. And it's a business. And then if we operate like a business, automatically you start to manage costs. And you'll soon realize that trading the euro in this fashion is the cheapest. And you don't need more than a couple hours of work every day. You don't need to trade 18 hours per day. You don't need 6, 7 swing trades on 6 or 7 different instruments. I do swing trades, but not in this particular account and not with the euro, right? So I have pages in the playbook. This is just one page of the playbook, right? This is just one way of milking the cow instead of betting the barn, right? So, yeah, in theory, what we're trying to do is milk the market, right? We just want to extract the same consistent return over and over and over. And then ultimately you're looking to create stuff that looks like this. This is 55 trades in a row and they're all the same size, right? And then if you leave the casino every day, typically on schedule, you avoid the casino winning. You avoid it taking its money back. The people that overtrade tend to lose in the afternoon the wins that they earned in the morning. And so right here, right now, I'd be wise to call it quits. Maybe give back that $1.60 and walk away, right? Because I've already won. I've already profited from the casino. My pushing my luck is just asking for ruin. And that's where the 2-hour business day comes in. right? It's not because I'm afraid to make money. It's because I'm afraid to lose it, right? And so this methodology, this thesis requires timing more so than I think any of the other strategies. I use time to exploit volatility because I know it's there. And by the same token, time of day tells me volatility is about to disappear. And so I don't want to get stuck holding the bag when there's no exit coming my way. Right? So if I can just close a couple of winners here, as we speak, it's the bottom of the hour right now. Right? The bottom of the hour, 9:30. And so we are approaching the banker's close. The banks in Europe have to set the stage to close. And so the bankers in Europe don't work overtime, neither do our bankers. And so the banks will close on schedule. And with that behavior comes an influx of volatility. Right? So everything we do and everything I do here has a circadian behavior behind it. Right? Somebody is doing something for a reason. And then when that somebody goes home or goes to the pub, my business day tends to slow down and stop. I finish trading by lunchtime New York, right? Because the bankers in Europe are done for the day.
You compare the market to being the casino. I know some traders say you have to be in the casino yourself. Tell me how that plays out and kind of how you differentiate.
Yeah, so I trade probabilities. And so what happens, I'm not necessarily waiting for the confirmation. I see the market unfolding. I see the trade set up. And because I've seen that same setup, 80% work in my favor, I'm willing to bet on that 80%. And so I don't need that confirmation bar, which is half of my 3 pips. I just trade preemptively. And basically what I'm doing is I'm trading the next move, right? So I'm trading like Wayne Gretzky played hockey, right? If I'm selling, it's because I think the market will eventually go down, even though it might be going up right now, right? So it's much like a casino is postponing gratification. Right? It's okay to let the guests win right now because in the end, we're going to, the house will win in the end. It's kind of what I'm doing here, right? I'm spreading my risk as the market is moving against me, delaying or I guess postponing gratification. And eventually I get paid, right? Just like the casino put 2 green squares on the roulette wheel just to shift the odds in its favor. Otherwise, it's 50-50, right? So my edge basically revolves around time of day and support and resistance, right? I don't really care much for supply or demand, considering supply was yesterday and demand is right now, right? So I'm trading support and resistance as I see fit. And this is just an assumption, which is the best part, right? It opens me up to being wrong all the time. I don't have to be right all the time, right? It's an assumption. It's okay to be wrong because it's so cheap. It's a microscopic amount of money compared to the account that I'm working with. It's the willingness to make that mistake and to spread a little bit more risk, and eventually you've postponed gratification, you've built a position that should, that's the word, right? That should pay off. And so the probability exists that things just keep going the wrong way forever and ever and ever, and you have to know where to stop. This is where the ejection seat comes in. All right, so I have this limit. I'm not trying to pick the top. I'm not trying to pick the bottom. I just happen to be here when it's forming. I'm not specifically targeting the entry like a dart. Right? This is more like spreading butter on my toast, and I know somewhere in this area I'll find the swing that I'm looking for. I'm just playing the ballpark. I'm playing the environment. I don't need perfect accuracy, which for a long time had me chasing my own tail. We were looking, or I was looking for accuracy with the entry. I needed the best entries possible. And I've come to realize they are not connected to the exits. I make my money when I close the trade, not when I open it. And so managing the exit is more important than managing the entry. The entry is a probability of success, right? I was led to clicking my mouse because all the check boxes checked. It leads me to opening a long or opening a short. With that has a probability of success, 93, 94%. And if I'm right, I make money 94% of the time. Those 6 out of 100, one of those 6 has the ability to wipe me out. And so it's my job as the risk manager to catch the losers. All right, so here in box number 2, I would have been wise to take another trade. I'll take 2. All right, so now I have 2 trades in box number 2. I have 2 trades in box number 1. 4 trades in total, the average of which is between the 4 trades right there. And it's cost me $4 of drawdown to move my break even up. All right, so now my break even is within reach. My break even is 1 bar away. All right, and so I don't need a big move. I don't need the tide to lift my boat. Right? I just need a small move in my favor, and that drawdown disappears. Becomes profitable. It's like a caterpillar. It's like walking a caterpillar. It pushes the front and then it pulls the back. Right? So I have 4 boxes, and I can only have 4 boxes. If the market require box number 5, I have to close box number 1. Right, so I'm only using the money that I have in the box that it's allocated to. So I'm allowed 1% per box. I'm allowed 4 boxes. That's basically it. I just spread the money as I see the opportunities presented. And in the end, the next move, right? So the next move is anticipated to be something like this, right? Something that reflects the past. Right? Anything can happen, but this is the beauty of what we do, right? The probability is where the money is. I trade probabilities, and I'm having fun doing it. I'm wrong a lot. I'm wrong a lot, and I still come out ahead because I'm averaging my mistakes.
Explain me how you're wrong a lot, and then you have a 94% win rate. And I'm curious to see how that plays out.
Okay. So here, being wrong would be something like this right here. So, right, so the market's coming down, and I sell on this. Was a green candle at the time. There would have been a green wick there. I sold the green wick. I made a little bit of money. Green candle, I sell again. And instead of making a little bit of money, I was wrong, and the market pushed up. I sold twice more. I had to wait 15, 16, 17 minutes to make money. I was wrong. 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 I was wrong a lot, right? But I was building a position across the box. And in the end, all of my mistakes ended up making me money. Right? So carrying drawdown in the layman's mind, it's a mistake. Drawdown in the average Joe's brain is a loss. In reality, drawdown is just an open trade. It's necessary evil. You have to have drawdown. You have to. And so you can work to minimize it, but it will always be there. Every click you click on starts negative. Right? And so I'm content operating within drawdown, and I have this envelope of drawdown that I work within. It's 36 pips or less. right? So I have this bubble of risk that I'm willing to operate within. And inside of that 36 pip bubble, my job is to make as many 3-pip trades as I possibly can. But they're not random. I'm only selling because I see resistance on a green candle, right? If I was buying, if we go to yesterday I was a long. Yeah, so yesterday I was buying. The day before I was buying. Right? We make mistakes all the time doing this, all the time. But in the end, with time, you find break even. Right? You engineer an exit that's less damaging than the stop loss. Right? So here we averaged 4 trades together, and now we're literally breaking even. We're $1 away from breaking even. Right? So instead of taking one trade and waiting for one outcome, I took the same amount of risk, that 1%, and I spread my 1% to engineer an exit that will deliver something other than, one or the other. When you're swing trading, you're relying on one exit, and you don't have control over that one exit. Right? It's predefined. You have your 2-to-1 risk to reward ratio, and you don't interfere. What I do is I define the risk, and I interfere with what the market is trying to do. Right? I change the outcome by changing break even. All right, so we've just made some money there. We just closed a couple of puff.
Got me to what happened there. So you have 2 trades that closed. These are the trades that took higher. Did they reach the take profit or?
Yeah, they reached the 3-pip take profit. And so we booked those profitable trades. And as such, the break even moved lower. It's now reflecting breaking even for the remaining 2 trades. And see that green candle there? I'm recycling the 2 trades. Boom, boom. All right, so I just took back the same 2 trades. Okay, so I made a little bit of money. I'm putting the 2 trades back on in this box. So the money that belongs here is here. And I'm hoping to basically recycle the exact same trades, redo what just took place. All right, so it's like rinse and repeat. Right? If I'm wrong, we will test the next level of resistance, and that opens me up to clicking a couple more trades. Right? I can only have 4 clicks per box, and so I need to be recycling the trades like we did here, over and over and over and over and over.
Tell me about your bias. Does your bias change in a given? Because today you had 2 different biases. Were going short and then you were going long later. So what makes you decide to go short or long at a specific level?
So I start my day with the schedule in mind, and then with that scheduling thesis, I find myself near the top or near the bottom of the day at the same time of day. And so with this information, I realize I don't have much more to go. I'm here for the North American session, which is the end of the day. And so I'm here to fulfill the average daily range. If I can fulfill the average daily range, odds are the day's over. Like the volatility will shrink away. And that's typically what will happen. There's times during my 2 hours that I find myself having to reset my bias. But odds are it's one bias for the whole 2 hours. It's also very rare that I'm here for the full 2 hours. Right, so the 2-hour window is there, but I don't use the whole thing. So more than likely, I'll find the bias from the top-down analysis. I'll trade that bias for 30 minutes, an hour, and then I walk away. If I end up sticking around longer than that, I find myself having to change my mind a few times during the day. Right, it's every one of these cycles here, every one of these up legs or down legs. It's either what I'm trying to do for the next 2 hours, or it's the opposite. It's counter trend to what I'm trying to do for 2 hours. Right? I'm not here forever. I'm only here for the next move. And as we speak, you and I are trading this as the next move. Right? This is what I'm building a position for. All right, so I'm not looking at this, I'm looking at that. And then if I'm wrong,
Just to make it clear, so the resistance area on your 1 hour chart, right?
yeah, I'm looking at this area here to see if we break this, maybe I'm wrong and I need to average out. If we bounce off of this, I'm probably right and I'll be making my money on the way. Right? So it's a seesaw, like a teeter-totter. And I just choose which side of the seesaw I put my money on. The proof has to be there for me to change my mind. I don't want to flip-flop. I don't want to play ping-pong, ping-pong. I want to play ping, 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 and then switch to pong, 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 pong. And so it's ideally, I know when I'm wrong if I've gone into box 3. Right? Boxes 1 and 2 are reflective of an average move. Boxes 3 and 4 are beyond an average move and usually call for, a break even. And so it's this security blanket. It sets the stage for me to understand what's taking place. What do I need to do here? Because we've moved 4 boxes. The people that don't track this kind of stuff, they think the market's on the way to the moon, right? Oh, it's on the way to the South Pole. It's not. It only moves average upon average upon average. It's an average day. Sometimes it does more, sometimes it does less, but it doesn't do 5 days in one afternoon. Right? So this is why we have to keep our mind grounded. And this is where the box helps me ground my expectations. Right? If I assume this is a high, I put the box on that assumption. And now, because of what I'm working with, I would expect the price to waffle its way in this box until here. It should take about an hour. Anything faster than an hour is a clue that there's probably more volatility coming and maybe one more box. Right? So a normal market takes its sweet time to move 9 pips. Anything that's not normal or volatile is faster than an hour, and therefore you probably get more than 9 pips in the hour. Right? So it's one versus the other, and I realize which end of the spectrum I'm on, and I put my money there. I understand when things are shifting away from me, boxes 3 and 4, and I understand that's becoming problematic, right? It's not looking favorable. And so that's when you start peeling out the losers. Instead of hoping and praying things go, you take action, right? You remove them. All right? So understanding what's unfolding, the next move, here we are, the next move is kind of what we participate. We take part in this. Right? And it's only because we can measure the past. I can see, okay, this is done an average. What's the probability that it does 2 averages, 3 averages, 4 averages? Right? Think of it as a recipe, and this is a measuring cup, and you're just measuring the recipe. The market moved up 1, 2, 3, 4, 5.5 boxes. Right? We don't change the size of the measuring cups. We change the recipe. All right? So the market now has retraced 9 pips. And because it's doing so much faster than expected, we would expect another box. The next hour could be spent in here. Right? And there's also a probability that we bounce off of here and go back up. Oh, there's the break. Right? So now we expect this as the next target. Right? See, if you go to the ladder that we drew earlier, we broke the level. And so now we're targeting the next rung on our ladder. All right, so if it pushes back up, a green candle, I want to sell expensive. right? I want to see a green candle and I want to take it on sale, basically sell it. Right? If it's red, I'm chasing this, and I don't want to sell it when it's the worst price. Right? And so the box allows me to see what's happened, see what should have happened, and understand what the market is capable of doing still. All right, so we've had 1, 2, 3, 4, 5, 6 winners in the last hour. It's not so bad.
Not doing bad. That's pretty cool. But it shows how people sometimes should not listen to common advice. Like people say, oh, you have to buy on a green bar, you have to sell on a red bar at these levels. You're doing it like the opposite way, which is kind of cool to see that you can do it that way too.
Yeah. As long as it works for you, as long as you understand where your idea is flawed, right? So you have to highlight where this is not working anymore before you click the mouse. And so for me, this not working anymore is 36 pips. And inside of that 36 pip zone, I engineer what I'm looking for. If I go and buy a new dishwasher tomorrow, I'll figure out how many clicks I need to pay off that dishwasher. And then I'll do 20 or 50 clicks per day and leave the casino. Right? I don't want to blow my luck at the casino. And so this is it. If I push my luck beyond 2 hours, so if I'm now trading when the volatility is shrinking, I'm holding the bag and I really don't know what's coming next. It's now up to the environment, right? If I trade that 2-hour window, I'm trading a neighborhood that I'm familiar with in. It's like driving to work. You leave the house on schedule, you follow the same road, and you get to work on schedule. And if anything creeps up in your path, you'll still get to work on schedule, right? You'll figure it out. That's what trading on schedule is, right? I expect normalcy, but I deal with the facts. And my normalcy is 2 to 3 boxes. And if I need a fourth, I need a fourth. There's no sure thing. There's just one process that I exploit. And it's one shovel that digs the hole or it fills the hole. I don't go get a new shovel because I created a problem for myself. Right? So, no, it's one set of instructions will create a big mess or fix the big mess. It's the operator. There's my green candle. Sell. Right? So I'm not selling the house. I'm only selling one tiny trade. And if I'm correct, I have a win. Feels good. Doesn't have to be $1 million, right? The good feeling is really what I'm chasing. And then this good job, the recycling of the trades uplifts. It's like you start your day with a glass half full and you finish your day with the glass half full. Once in a while, you'll get cornered, you'll get painted into a bad position, and you give up a few trades, right? But that's what trading is. I don't win all the time. I take losses. Just yesterday I took 6 losses that cost me almost $100. I'm still trying to recover that $100 from yesterday. Right? But this is the kind of stuff, right? I'm dealing with the facts as I see fit, and I'm trying to overcome my losers with an overwhelming amount of wins. Highly probable, readily achievable 3-pip trades. Right? I'm not asking for the moon. I'm just asking for 3 pips over and over and over. I do have losses. They're upside down. They're bigger than my wins, but they're far and few in between. Right? So, here we started with 11,000. We're up $700, and it's only been 3 weeks. It's only been a week, 2 weeks. Right? So the strategy works quite well. We just have to understand where you have to say enough is enough each day. And so that's a 2-hour window. Maybe it's a 20 pip target that you have, or a 20 trade target that you have, you have to have this potential average yield and walk away when you've reached it. A lot of people I work with, they don't have this expectancy. And so they start the day hoping today will be the day that they figure it out. And it will not come in one day. It will come in a series of days over 20 years, So, yeah, the strategy gives you the freedom to make mistakes. And those mistakes have to be looked upon as opportunities to learn something. I'm always learning something new, man. I'm having fun doing this.
I love it. Tell me about these boxes and this target you have for the day. Is it based on the ATR? Are you able to get this right away from the ATR, or did you have to go in the market manually to look at the box and movements and everything?
Well, the boxes came from the market itself. So the box was measured on a 5-minute chart. And so the average moves on a 5-minute chart right here, these average swings are about 9 pips. And so this is where the box comes from. We just happen to use it on a 1-minute chart because now we have 60 bars instead of 12. Right? The box in reality only has 12 5-minute bars, and that was not enough opportunities. And so once I zoomed into that 12-bar box with a 1-minute chart, it became 60 bars across, 60 bars at right now 1.5 pips each. ATR was not part of the plan, but it became part of the plan because I noticed the consistency was always there. And that's where this potential average yield came to be. And so I started by focusing on the time of day to minimize risk. But then I realized that same time of day gave me the same paycheck. And so that became potential average yield. Right? So some days it's $50, some days it's $300, but over time it's average. And it's within that 2-hour window. My biggest losers always come from the trades that I take before my 2-hour window. So if I show up to my computer an hour early, those trades will cost me at the end of the day. If I trade within my 2-hour window, I can leave the casino problem-free. So it's reviewing the mistakes, reviewing the journal really opens up, what your potential is. And then after a little while, you realize, hey, I do the same work every day. That becomes your paycheck, And I'm not looking to reinvent the wheel. I just want to make it go around. And that's where the top-down analysis came in, right? The top-down looks at 2 groups of people. It looks at the daily traders, and it looks at the intraday traders. And then I try to align the two together, right? I try to see what the investors are doing with the day traders. If we have the same ideology, the same thesis for today, it tends to help me. It lifts all boats. The theory gives you the flexibility to try this on any instrument out there. Right. I have a friend that trades the same thesis on the DAX. There's another fella in our community. He does this on the Aussie yen. Depending on where you live, that 2-hour window is different for you than me. And so you have to trade what works for you in that 2-hour window. Right. So, yeah, the box is there. We just have to figure out what the box is for whatever instrument you choose to trade. All right. I trade something very similar to this when I do MNQ, NASDAQ. And it's the same idea, but the box is a lot smaller and everything is a lot quicker with futures and a lot more expensive. But it's the same thesis, right? Standard average moves. And you can track that with your mind's eye. You can see what an average move looks like, and you can expect when the average move is finished, right? This right here, right? If this is an average move, which it was over and over, right? Is this now going to bounce? Oh, look at that. Right? Is it bouncing? I think so. Right? There's that big wick right here. Right? So that's the kind of stuff we look for. That's the kind of stuff we play off of. And our trades don't last forever. They only last 1 or 2 bars. And so it's the recycling of your trades that make you the money. You know, I don't want to be placing 10 trades per day on 10 different instruments with 10 different targets and 10 different stop losses. I would rather repeat one trade 10 times.
And looks like you're gonna trigger that. That's pretty good.
Yeah, so we've made a little bit of money. We had a good hour of discussion, and you know, if people need more of this, you know where to find me.
Yeah, tell me where can they find you, then I'll connect with you or reach out after this interview.
Well, the Jasper Forex YouTube channel has been up and running for about 3 months now. So I've got about 90 videos. So there's a lot of information there if they want to review hour-long trading sessions from the past. I also trade this daily live in front of my small community of traders. To get into that community, you have to follow jasperforex.com, the website, and then go through that process. But I upload videos daily, and it's from live sessions that I do that morning. And so you can see, you know, how things evolved for yourself, you know, how I did it compared to how you would have done it, so to speak.
Awesome. I appreciate your time here, Jean François. A lot of good advice. As always blowing my mind with these interviews here. So I really appreciate that. Hopefully we can do another one in the future and connect with you soon.
Awesome. Thanks.